Why was it different in 2008? I mean, they seemingly did let the market fall, and we did see the markets crash by 65%. And so now you're kind of saying that they can't really do that.
2000 was less of a debt cycle and more of an equity cycle. The debt cycle in 2008 really was the kind of end of the financial system. It was the point that we all knew was coming, which is like, you can't have this much leverage. Look at what's happening. We're decentralizing power. So now people can have the source of power at their houses. So therefore you don't need the huge storage. People say, well, you can't scale solar. Well, you can at a house level. You can do it probably at a village level.
You know, Sam Altman said that we might see the first single person $1 billion company. So I think of it, there's both, right? The centralizing of the programming, but then it's decentralized in a sense it turns one big company into 100 or 1,000 companies. There's no future in this world where humans don't have problems. And as long as there's problems, we'll need solutions to those problems. And entrepreneurs will always be able to figure that out. So
nature's going to trade at a huge premium in a world of robots and AI when you can just kind of leave that all behind. If you ask a young kid now and say, what do you want to be when you grow up? They will say, I want to be an influencer. And we think, are you crazy? But what is an influencer apart from a community leader where they have a community of people? It's actually, maybe they're being adaptive already. They've done it in Fortnite. They've done it in the gaming world as well. But in the end, people want the human to human experience.
Raoul Pal from Real Vision. You have been, you've been laying out some really good research. I've been waiting to talk to you. It's been going on for like a month, waiting for this. So anyway, thanks for joining me today. I'm ready to dig in.
Yeah, sorry I've been so avoidant, but I was on holiday and it all got a bit screwy. But we're here now, finally.
We're here now. So the everything code, the banana zone, you've been putting out some really, really good research that I'm excited to dig in. I was just telling you, I just came back from the Bitcoin conference, and I'm starting to see this big shift in the industry. It seems like where we're seeing all this institutional adoption that's just coming in. And it seems like it's changing sort of the makeup of that industry. We'll come back to that. But let's go ahead and just set the stage here. And the everything code. I've been loving it. This phenomenon where you have like these metronomes that keep perfect time for playing music. And this phenomenon where if you set all these metronomes on a table and start them at different times, over time they all get to the same beat. And I think that sort of maybe sums up the everything code.
Yeah, and what's weird about the everything code, and I'll explain what it is. What's weird is it makes everything so simple.
Too simple.
That most people think, well, this can't be possible.
Yeah.
We kind of knew it in Bitcoin world because we could see a cycle forming. And we've been following this cycle kind of dumbly, like, well, it's kind of maybe just the halving cycle. We don't really know. And then I started digging in and realized that the business cycle was perfect. So the business cycle, I used the ISM survey, and it was a perfect cycle. I'm like, that's weird. Because if you remember, go back prior to 2008, we'd have these long periods of no recession, short periods, and it was variable. But suddenly it's like a metronome, as you say. I'm like, what's that all about? And eventually it led me to realize that 2008, I think, was the Great Reset. The one that people keep expecting happened. What they did is they basically they told everybody they could forego paying interest on all their debts, which was zero interest rates. And then they tried the new trick of printing money via quantitative easing. Now, what that did is allow every single major government in the world to refinance all of their debts on this 3 to 5 year sector. And so they all did it. And what it did was force the business cycle into this 4-year cycle. And then all the asset prices are all correlated. Whether it's tech, whether it's Bitcoin, whether it's the economy itself, it's all driven by the same cycle, which happens to be the presidential election cycle, which happens to be the Bitcoin halving cycle. It's all the same thing. And so when you understand that, it makes the game a lot easier. Now, this is not going to last forever. But for the period of time that we've got, it seems to be playing out perfectly. And you can break these cycles down to 4 phases, which I call the seasons. So we have, call it crypto or macro winter. Well, that was 2022. That was 2018. That was 2014. That is 4 years. The next part of that is spring, when nobody quite believes that something is changing. but prices start moving higher. Bitcoin had a great year in 2023 against most people's expectations, because spring is the time the shoots come up. Then you start transitioning into summer, which is this year, which happens to be the election year, which is when really the debt starts getting refinanced and they have to start using liquidity to finance it, because there's not enough GDP growth to pay for the interest on the debts. And so they keep rolling forwards these debts and they keep monetizing the interest payments, which is this debasement of currency that happens at about, on a globalized level, 8% a year. They're debasing currency. And then next year will be macro fall, and then eventually the cycle tops out and we repeat it again because it's based on the debt refi cycle.
Right.
That this debasement of currency of 8%, there's two ways of looking at it. You can say, rightly so, we're being robbed of our future wealth because your future self is getting poorer because you can afford less assets with your income, because income doesn't go up, the assets do because of the debasement. Or the other way is you can say, I'm paying an 8% put option fee on the entire system not breaking, because that's also what they're doing. Because they need to refinance the debt. They need to not let asset prices go too far down. So we can talk about that, but it's another way of looking at it. And you're like, would you pay 8% a year to have the entire system not break? Maybe.
If you have assets, for sure. If you don't have assets, that's a different conversation.
Exactly right.
Right. Depends on how much you have to lose. So to kind of just maybe rewind the clock just a little bit, because we're in a debt-based monetary system, then we have to have this debt expansion. And so then we have this debt that has then been become collateral for more debt, which means the debt always has to be rolled over. And as President Biden told us on the last debt ceiling debate, that the U.S. has never defaulted. And so we have to raise the debt ceiling so we don't default on the previous debt. Right, which is basically what you're saying. We have to raise more debt to pay off the existing debt.
Yes, and then pay the interest on that debt, because it compounds every time by the interest payments. So you keep adding debt just to pay the interest payments on the old debt. Now, why is that phenomena there? It's pretty straightforward when you understand it. The US government and all the major Western governments, plus Japan, plus a few others, are about 100% plus of GDP in debt. Now, let's say, theoretically, interest rates are 3%. Well, if GDP growth is at 3%, then all GDP growth goes to pay those interest payments. Okay, but the problem is the private sector is over 100% of GDP in debt as well, and it's got interest payments. So if they both have it, there's not enough GDP to cover it. So what they've essentially done is removed the government debt payments out by printing money. And that stops the whole system becoming illiquid. Because if you think about it, you talked about collateral. Collateral is the money pledged against a loan. If the collateral falls too fast or too far, then you break the covenant on the loan and it gets called on you. And that's the whole system. That's what happened in 2008. So the best thing to do is not let the collateral fall by debasing the currency, and optically it goes up. So it kind of stops the system imploding.
Yeah. Now, you talked about this, the phenomenon where it all got synced up in 2008. We'll get into that. But just going backwards, why was it different in 2008? I mean, they seemingly did let the market fall, and we did see the markets crash by 65%. And so they did it. We saw it in 2000, right? We saw it in 2000, we saw it in 2008. But now you're kind of saying that they can't really do that.
That's right. 2000 was less of a debt cycle and more of an equity cycle. The debt cycle in 2008 really was the kind of end of the financial system. It was the point that we all knew was coming, which is like, you can't have this much leverage. And if the collateral, which happens to be house prices, which is not a volatile collateral, once that starts, it put a collateral call on the entire system. And faced with the entire blowing up of everything, they decided to stop it. Now, I don't think they quite understood what they were doing at that point. But then Europe had the same issue in 2012, 4 years later, this 4-year cycle. Then Europe, the governments couldn't pay the debt. Okay, now this was a sovereign crisis of giant nations. And Draghi said, I'll do whatever it takes. Right, and what that was, I will debase the currency to stop the collateral falling so we can shore up the system. That then magnified the whole thing.
So was it a change in their willingness to do whatever it takes, to the point Draghi said, whatever it takes? Was it a change sort of in their willingness to intercede, or was it a fact of that the system has gotten so over leveraged they have no choice now?
Yeah, so this is the time I got into Bitcoin back in 2012, because I was living in Europe, and it got so bad that I was buying tinned food and a generator because I thought we were going to lose our banking system.
Wow.
Because everyone, I was living in Spain. Spain was forced to take a bailout of $19 billion. They didn't want to take it, and we thought we were going to lose the banks. Cyprus obviously lost its banking system. They took the money out of everybody's accounts. But what was interesting at that point, I went around the world trying to start the world's safest bank with a bunch of friends of mine, some family offices and stuff like that. And we had a private meeting with the DTCC and Euroclear and the New York Fed. Now, the DTCC and Euroclear, they're the custodians of the entire system. And Euroclear, I'd read somewhere, had to lend emergency money when Lehman went under, $50 billion. And so I asked them, I said, what was the collateral for that loan? And they said, oh, we had to use the positions from all of the members of Euroclear. And I'm like, is that customer or house account? Is it mingled? And they're like, oh, it's all mingled at our level. We have a claim on all assets. I'm like, okay. And then I spoke to the DTCC and I said, I spoke to Euroclear and said, what happens if Spain or Italy went bust? They said, then the entire collateral of the system is gone and it's a total wipeout of everything. That's when I realized how important the government debt was. I asked the DTCC and the New York Fed the same question, and they said yes, they would lend if JP Morgan went under or something. They would lend money to the system, and they would take customer positions as collateral. I'm like, okay, so you don't actually own anything. And I asked the New York Fed, I said, what is the leverage in US Treasuries? And they said, we think Treasuries are levered up to 42 times.
Wow.
So there's 42 claims on the same asset if shit hits the fan. That's what they're scared of. And that, I think they had the realization in 2012, and I think they all understood the game, which was, okay, we're going to have to continue to monetize this until we can grow our way out of it, if we can.
Right. So I remember 2008 is when I sort of woke up to the macro world. I had been a real estate investor coming out of the 2000 crash. And then, I got woken up in 2008. I said, wow, I need to go figure out this macro picture because it has all this control over my life I've been paying attention to. And that's when I really remember hearing the first, too big to fail sort of narrative coming out of it. And so they bailed out a lot of these institutions, AIG, that were too big to fail. But by doing that, they made even bigger institutions that are too big to fail, it sounds like.
So there's a really important point. I asked them directly why they let Lehman go, but they didn't let AIG go. And they're like, nobody was using Lehman bonds as collateral. AIG were AAA and they were going to go to zero. And AAA bonds get used massively as collateral, and they thought there was 32 times leverage in AIG bonds. They're like, we could not allow it to go. Lehman wasn't as existential a problem as AIG. I was like, wow, that's fascinating.
And so now the system has gotten so levered up, and there's so much collateral staking other collateral that now we're sort of in this position that's gotten bigger, worse, that they just can't let it go now, which is what we saw in 2020.
And we saw it in 2022 as well. So the moment the markets go down a certain amount, the liquidity comes back. Even though the Fed was still tightening and they were doing quantitative tightening, the actual liquidity started picking up at the back end of 2022 because they're like, enough. We don't want the S&P to fall more than, let's say, 25%. And that's kind of a line in the sand that we've seen repeatedly, that every time it starts to get a bit wobbly, magic of liquidity comes back, they debase the currency, and everybody's okay again. Because if you think of the other big liability out there, we talked about ordinary people. Ordinary people do have a pension. And those pensions are in these assets too. And you've got this massive cohort of people that if you let the pensioners lose 50% of their wealth, at what average age of baby boomers, average age is what, 71, 72? Well, that's going to destroy consumption because there's 76 million of these people. So they don't want to do that too. So they're between a rock and a hard place. And I ask a lot of people who complain about what's going on, and rightly so, is what would you do different? Are you going to default on all of the baby boomers and destroy their pensions and then destroy the entire economy? Or do you let all of the system go under because you don't have any assets? It's very difficult to actually come up with an answer that is reasonable. They're all shit. They're all shit answers. So maybe the least shit is 8% a year.
Yeah. The other problem is I've talked about where the government can't really afford a recession either, or a market crash, right? I mean, a large percent of their revenues come from cap gains and just income overall. If the stock market crashes through a recession, we typically see a 12 to 15% drop in tax receipts. And when we're already running deficits like we are, that would also be catastrophic.
Yeah, particularly if a bear market lasts longer than a year. So a year they can pretty much buffer as long as it's not too big. But if it grinds on for 2 or 3 years, you're right. The tax revenues don't add up. People get tipped out of jobs, so there's less other revenues coming. So it's cap gains, it's earnings, it's household income, the whole lot. And then before you know it, again, exactly the same issue. I hadn't really thought of it that way, but that makes total sense. You just can't have a long-term recession right now because everything is resting on it.
Right. Okay, so that sort of sets the stage for the everything code. So we understand the mechanisms of why the leverage is there and why they can't really let that crash and they have to continue to inject liquidity to keep it going. Then, as you said, in 2008, that metronome moment sort of happened when, of course, if the bank is going to give you 0% loans, you're going to refinance. So to the point that you made, everybody refinanced at that time. Now, that was most of the debt. I mean, that was corporate debt, household debt, business debt, everything, and that was also global.
Well, corporates actually did longer-term debt. It was the governments that really did. Households didn't get access to debt ever again. So, household debt to GDP has been falling for a long time, and corporate debt to GDP has been generally falling because tech stocks have become more dominant and they don't have debts. Old economy stocks do. It all shifted. That shrinkage of household debt and corporate debt is exactly the same amount of the increase of government debt. So it was just going from one balance sheet to the other.
Got it.
Because on the government balance sheet, you can debase currency. On the corporate balance sheet or the household balance sheet, you can't do anything.
And then there's a mechanism also that you've talked about that's sort of in place because of the demographics. And with falling demographics that we're seeing sort of through the developed world, that's also forcing the government to continue to debase or continue to sort of add stimulus into the GDP?
Yes. So if you think about an aging population, if you think about your parents, the older they get, the less they spend. So aging populations tend to have lower trend rates of GDP. They all do. It's happened observable everywhere because old populations spend less. They also tend to not know how long they're going to live for after they retire. So when my dad retired, his spending must have fallen 60 or 70% because he's like, well, I've got this much money. I don't know how I'm going to live for. Is my wife going to be taken care of? And so they change their habits. And so that drags down GDP growth, as does debt. And so it keeps compounding this whole thing. Is right now, for example, interest rates are at 5.5%. But trend rate of GDP over the last 5-6 years is about 1.75%. So you've got this big gap and you need to get interest rates down so you can refi them. But all the time, GDP keeps falling over time. And you can forecast it into the future. It's just the births, deaths. And it gives you 30 years of understanding. And it's just telling us, unless something dramatic changes, which is technology, we're just going to keep dragging down GDP forever. And we're seeing it worse. Older populations, Japan, China, most of Europe, they're older than the US because they had less immigration. What you find is their GDP keeps shrinking. Australia, on the other hand, has a high immigration rate, as has Canada, and they've tended to do better because of the immigration rate. Because really, GDP growth is driven by population growth, productivity growth, and debt growth.
Right. Now, I've read into the demographics quite a bit. I remember Harry Dent Jr. wrote a book, The Demographic Cliff, that sort of kind of showed these predictable spending patterns as you age through life.
Yeah.
But another thing that I've heard, though, is that the baby boomers have so much money. They're sitting on so much wealth right now. And a lot of them, they're like, well, we're going to die, so let's just spend it all.
I hear this a lot. There was a paper written at the BIS or somewhere about this, but it's not provable in any country anywhere. So I've gone through all the demographic data, and there was this whole thing saying, well, it's inflationary. I'm like, well, show me some fucking evidence. And I went through every single country. There is no evidence of inflation. They tend to be hoarders. Now, what happened in Japan was that aging Japan cohort, their kids retired by the time they passed it on to them. So a lot of them actually pass it on to their kids. But in Japan, it was so bad that it went from retiree to retiree.
Right.
So it never recycled into the economy. So I don't see evidence of baby boomers saying, well, I'm going to spend it all. Because, that's okay when you take the average pension or retirement savings. When you take the median baby boomer is 150 grand saved.
Right.
And they need to live for 15, 20 years post-retirement. They can't.
Yeah. Well,
How are they just going to blow it on, cruises? They're not.
Yeah. I mean, in the U.S., I believe about half of them have no savings. And then I think the
That's
median
right.
that do have savings is about 150. So it's even worse.
Yeah, which is terrible. But when you look at the average, it's like $1 million. Yeah, sure, because Jeff Bezos is in it.
Right.
But, that skew hides a lot of bad stuff.
Yeah. Now, when you're looking at this, you've gone back and forth. Seemingly, we were talking about the U.S., but then you pull in sort of the West, so Japan, China, Europe, et cetera. So it's important to sort of look at this from a global perspective, especially when we're looking at like global assets like Bitcoin.
It is very important because I believe all of these central banks and governments understand the game that they're in. And I think the Japanese figured it out first. They were the first to do quantitative easing. And I believe that somewhere around 2012, with the rescue of the European system, they all got together and said, we will all have to run a liquidity cycle to do this, and that there is a game that they play. Because they kind of know. What's interesting is people always assume central banks are stupid. I find that a bit hubristic to think that they are. Maybe they just don't want to acknowledge what they're trying to do. But it would make total sense. And the more you think about that, the more you see it, how they're also connected in what they do and how they do it. And it's all like a tacit agreement is, okay, time to go. And they all go again.
Yeah. Now, so we have these problems, and now we're in this synced up cycle. You mentioned that it's probably not going to stay that way forever, but that's where we're at right now. What would cause it to get out of sync?
Well, most people tend to err towards it's all going to blow up. I'm like, show me how. If you can debase a currency, a global reserve currency, how's the assets going to collapse? You can't. It's like the Venezuelan stock market goes a lot in Bolivar terms. In dollar terms, it goes down.
Right.
That's debasement. So I'm like, I don't think that is the outcome. What I actually think of the outcome is, remember that magic formula, GDP growth plus productivity growth plus debt growth. Right, debt growth is stopped. It's just servicing of old debts. Population growth, we know, is negative out for 30 years. And what is the answer? AI and robots. They're infinite humans. And productivity, what is productivity? Productivity really is how much output per kilojoule of energy. Now, think of that as electricity costs. If you then think about, and a lot of people are like, the Europeans, they're nuts. Look what they're doing with this green energy. They're wasting money. They're not. Their entire job is to lower the cost of electricity, because that is the only way they can pick up GDP, because it creates the multiplier to productivity. They don't have the tech industry in the same way, but they have them and China are the big pushers of renewables. So the cost of renewables has been collapsing over time. It's down 99% over the last 15 years. So as it's getting cheaper and cheaper, eventually you can scale it enough that you will change productivity. On the other hand, you've got Japan, China, the US using AI and robotics, which creates infinite people. Now, if you've got infinite people, you kind of break GDP. I call it the economic singularity. You get to some point where GDP doesn't mean anything anymore. What does any of this mean? So if you've got productivity going up because of energy costs, and you've got infinite humans, or what, humans in inverted commas, then that changes everything. Now, people are going to say, oh, Raoul is smoking crack. This is all weird. This is exactly what happened after World War II. So let me talk you through that because it's really important for people to understand. World War II, so the crash of 29 was the system failure, same as 2008. World War II finished 1945. This was roughly like the pandemic because the global economy had stopped. Everybody was out of the economy because they were locked up at home or they were in the services back in the 40s. They all come back into the labour force, buy stuff because they've been out of the consumption for ages. The factories aren't ready. They're not able to deal with it. There's no supply chains. Prices rocket in both equations. 20% back then, 9.5% this time around. Okay. Then what happens is inflation fell, actually went negative soon after the first inflationary push. Then what the central bank did then, the Fed, was yield curve control, which is money printing, to service the debt. And they ran that policy plus fiscal spending to generate new cars, new factories, new all of that boom of the 50s that went into the 60s. Now, the other problem they had is, much like now, we'd lost like 20% of the entire male population of the Western world from warfare, 2 wars. So you had to replenish population or GDP couldn't grow. What happened? The baby boomers. So by the time they got into their 20s, it was the 1970s. They all go into the labour force at the same time, start buying a house, a car, a suit, a tie, everything. It creates a huge inflation because we had all of this consumption. But that over that period from about 1947 to about 1970, it was perfectly 4-year cyclical. It was exactly the same thing. The stock market did 900%.
So the productivity was led by the return of the people at that point and the demand that they had.
And the rebuilding of the world.
And the rebuilding of the world, reindustrialization, especially over in Europe that was completely destroyed.
Yeah, but the US too, all the factories, you think of, all of the famous goods of, washing machines, cars, TVs, that's all that period, right? So it's a huge productivity gain.
And it was also an explosion of debt because we sort of went off like an equity-based system to rebuild the world at that time.
Well, that didn't happen until later. And why that happened was the baby boomers started hitting by the early 80s when Margaret Thatcher and Ronald Reagan kind of opened the debt spigots to households. What had happened, because you had the largest cohort of people ever at the same time into the labour force, well, guess what? Their wages didn't go up because they're competing. Then as you go out further, obviously we had the World Trade Organization agreement and China. So now you're competing. So these people's wages in real terms never really went up. So the American dream was shot in the head somewhere in the, once their parents had them in the 1950s, and nobody realized what was going on. So what they started to do, as asset prices started to rise, they borrowed. And you can pretty much measure the difference in the rise of asset prices and the need to fund a future retirement by debt. And so they were doing a logical thing, which is I need to get on this ladder. But what happens is it just kind of got out of control. And then the governments did the same because you have to fund the pensions of this older group. The corporates got screwed with defined benefit pension plans for the same group. So it was the baby boomers were to blame, but they were all rational actors. They weren't evil people. If you want to blame anybody, blame their parents for having too many kids at the same time. And you can blame that on Adolf Hitler. And before that, you can blame it on the Treaty of Versailles for trying to force the Germans after World War I to pay for the debts of World War I. And they had the hyperinflation. Hitler comes into power. World War II, bunch of kids. The kids spend too much money, cause the great inflation. They're all fucked because there's too many of them. They don't earn enough wages. They start borrowing money, and there it goes.
All right, now we're talking about Bitcoin and the future of the financial system. I want to make sure you secure it properly. Millions of Bitcoin have been lost. Myself personally has lost a lot of Bitcoin, maybe worth millions of dollars in today's dollars. And so I've learned the hard way that I want to secure it with a hardware wallet like this. Keep your private key safe. This is a Trezor hardware wallet. You plug it in, you do your transaction, and you unplug it. Don't leave it on an exchange. I've lost it that way. Don't leave your Bitcoin on a phone. I've lost it that way as well. Secure it with a hardware wallet like Trezor. I've used it for over a decade. I think it's the easiest one to use. It's open source hardware, so you don't have to worry about some backdoor and someone rug pulling you and taking your Bitcoin. That's why I like the Trezor, and it's pretty cheap. And if you'd like to save even more money, there's a link in the description down below that you can save some money with it. But look, whether you use a Trezor or not, use something. Don't leave your Bitcoin on the exchange or at risk of getting hacked off of your phone. Secure with a hardware wallet like this Trezor. There's a link down below. Now let's go back into the video.
And we blame the Treaty of Versailles on the war, World War I, and really the War of England, which was really was really to blame because of the creation of the Bank of England that created a fiat monetary system that allowed these endless wars to go on.
Yes, and just I guess the UK Navy is the other one. But yes,
but the Navy came from the fiat monetary system that was created.
Yeah, which probably came from John Law, from the French fiat money. It's all connected, and that's what people don't see. People get angry with each other. We see the polarization of politics,
right?
But people don't realise that this was set off, as you were rightly saying, 200 years ago, maybe even longer. I don't even know where this thread begins. I haven't bothered to go back that far. But it probably goes back further and further and further. And it's just the machinations of this whole thing. And, we have these various blow-ups. 1929 was one of them too.
Yeah, I mean, you can go back. It's more like the volatility of life, right? The volatility of humanity and the pendulum that swings too far one way and overcorrects the other way. I mean, you go back to the 1400s when Spain went and found all the silver in Peru, brought all the silver back, and then you had massive inflation because you increased the monetary base too much.
It's exactly right. It's all, it's all the same. It's all the same thing. And I'm not actually a gold standard guy either, because we had the same problems then too. So I don't think we found an easy answer, because humans are greedy and they want leverage. And we've never solved that. You go back several thousand years and humans had leverage then as well. There's something about humans and leverage that we'd like to bring our future forward that is just like inherent in humanity.
Well, it's our ingenuity, right? So we are trying to get leverage, if you will, trying to get more output for less input. So create a wheelbarrow to carry 8 rocks at a time as opposed to carrying 1 at a time. And so the problem is our ingenuity maybe takes it too far, where then we start to steal from the future as opposed to just like trying to improve the future maybe.
That's right. I mean, a lot of people say that, kind of human GDP per capita and standard of living increases came from the ability to use debt to borrow a bit from the future, to leverage it, to create better outcomes. But then, yes, we always go too far.
Right.
It's just what we do.
I think the difference, what Mises broke down, is the difference of commodity credit versus circulating credit. So if I grow 8 bushels of wheat and I consume 6, I could loan you 1 of those bushels of wheat on credit, but that came from my supply, right? Versus being able to create the debt out of thin air. I think that's maybe where we sort of jumped or crossed the Rubicon or something.
Yes, but no, because if we think about the gold standard, we had 1929. We had plenty of those debt crises.
But wasn't 1929 because England left the gold standard, and when Churchill tried to go back to the gold standard, Keynes said, hang on, you've inflated the currency too much. You need to now reprice it at $60 an ounce. Churchill said no, went to 30, which then caused a massive deflation.
Yeah, that's possibly right. It was possibly the increase in the value of the dollar over the time versus the pound as we shifted from one economic system to the other. So that fracture.
So it was leaving the gold standard and trying to come back to a manipulated standard that maybe caused that whole thing.
Possibly.
Yeah, who's to say? So back to the GDP plus productivity plus debt growth. You talked about the rate of wage growth. And so the rate of wage growth is going up with the GDP growth, which is, to your point, about 1.5%. But the problem is that asset growth or price growth, maybe inflation, isn't really the CPI we've been sold. It's the rate of debasement, which since 2019 has been averaging about 10%.
Exactly
That's
right.
the real hurdle rate.
What you've got to understand is for each 1.5% of earnings growth, assets are going up by 10%. So each year, you can buy less and less assets. Now, what is an asset? An asset is future deferred consumption, whether it's for yourself in retirement or your kids or whatever it is. But it's a saving of wealth that needs to grow to compensate for how long it's locked up for, and therefore your future self is protected. It's your wealth, and if it grows enough, you make a lot of money. But the issue is, everybody's future self is getting poorer because every year you can't afford as much assets. Right. And so therefore, all of these millennials are just finding this in front of them that they can't buy a house anymore. They can buy less of the S&P. It's just a really messy, ugly situation.
Yeah. I have 2 daughters, and here I live in a little beach town here in Southern California. The average home price in this little town is like $1.6 million. And it's like, how are my daughters ever going to be able to live in this town like that they grew up in? Like, it's incredible.
That's right. It's like when I was in my 20s, I bought an apartment in London, and I was working in finance, so I had a relatively high salary, but the apartment cost me 3 times salary, 4 times salary. Then now the same thing would be 10, 12, 14 times. How can anybody afford that?
Yeah. So now we have the tech explosion. So cheap energy. I mean, China's building 150 nuclear power plants right now. That's cheap energy for sure. Cheap energy plus, AI robotics that you're talking about, which increases productivity, but I would assume that would also put downward pressure on wages as well.
Oh, for sure.
Right.
It's the biggest single most deflationary thing that has ever happened to humanity.
But if the productivity is pushing GDP up, then you would think that would also, if wages are growing at the rate of GDP and GDP is growing now because productivity increased, that wouldn't bring wages up with it. I mean, wages are
Yes, but don't forget the population shrinking, the human population.
Right.
So net aggregate demand actually doesn't increase as much because you're going to have all of these 76 million boomers dying off. And that's a huge drop in population because the replacement rates of population is so low.
Got it. Okay, well, so that's sort of this liquidity sort of refinance cycle sets the stage for that. Now, the next thing that's the everything code sort of summed up. Yeah. One thing I've been studying, I had Michael Howell on the show, and I've been studying his work. And he was showing how basically when you look at global liquidity, I'm not sure, he doesn't really break down exactly how he measures global liquidity, and you guys have your own proprietary. I'm not sure how much those correspond with each other. But the S&P 500 is basically moving up almost, I think, 90 to 95% correlated to the global liquidity. But then we have other assets like gold with a sensitivity ratio of like 1.5 and Bitcoin with like a sensitivity ratio of like 9. So how do you look at the global liquidity in relation to like the types of assets we should be buying?
So yeah, this was this is what got me on the journey. I got to this bit before I actually got to the everything code. Is they're all correlated. Some lead, some lag a bit, but they're basically all correlated to the business cycle. They always have been. But if everything is being driven by this one dominant factor, which is debasement of currency, and your hurdle rate is, let's say, 8% debasement plus 3% inflation or something, 11%, call it 12% for easy maths, on a globalized level. So unless you're making 12% returns, you're not going anywhere. Then at Exponential Age Asset Management, the asset management firm that I co-founded, we have this table of all of the different assets. And basically, the S&P is about 12%. So owning equities, which is why all of the millennials who have 401ks and they put it in the S&P still can't afford a house because they're just matching the debasement. They're not beating it, right? So they're not getting paid for locking up money for extended periods of time. The NASDAQ, about 17% a year since 2011. Okay, so the NASDAQ, because it's a secular technology trend, outperforms. Makes sense. And then you've got the bizarro world of Bitcoin, which is 150%. Gold actually doesn't beat it. Gold's about 8 or 7. So you're actually worse off in gold than you are owning the S&P 500, which is why that ratio keeps moving. So Bitcoin makes such a dramatic difference. So all I started doing was then dividing every chart by the total global liquidity, or even the Fed balance sheet, or M2, whatever you want to use, right? And you found that the S&P goes sideways, gold goes sideways, real estate goes sideways, roughly. The NASDAQ goes up, and Bitcoin does that. Okay, so now you've got only two assets in the world that outperform the debasement. Tech stocks, we get it. Tomorrow is more digital than today. Of course they're going to do well over time. And second is Bitcoin. So you divide one by the other, and the NASDAQ's down 99.97% versus Bitcoin. And once you see it like that, and you realize it's all driven by one cycle, which is one dominant factor of debasement, then it makes it really easy, which is just own the one asset that outperforms.
Yeah.
And because they're all correlated. And risk adjusted, it's by far the most superior asset we've ever been given on a risk-adjusted basis. So just do that.
Something I talk a lot about is a lot of different cycles on different types of cycles, mainly political revolution cycles, financial cycles, and then tech cycles. And you have like this conjoint wave, like this K-wave cycle, right? It's like a 40 to 60 year, I just call it a 50 year, sort of like a tech revolution cycle. And, there's been 5. I've say that we're entering our 6th one now. So the last one started in 1971, which was the microprocessor, which brought telecommunications, personal computers, and the internet. Before that, it was 1908, which was, the automobile, oil futures, but also mass production. And you can keep going back, but the key piece, and then before that, it was like steel, right? But it looks like during these financial or technology revolutions, it's not just the technology that changes the course of humanity, but that's the only place to invest. So the last 50 years, the markets have been dominated by telecom, personal computers, and internet. And the markets previous to that were dominated by Ford, GM, GE. And so then if that continues forward, then the only place to invest over the next 50 years would be into, I'm sort of thinking of it as like a decentralized revolution. So Bitcoin, the Bitcoin technologies, and even AI, I think, is decentralized in a way. And so it's sort of like maybe that's the only place to invest over the next 50 years.
So I tend to agree. There's this bundling, unbundling that goes on with the world economy as well. Centralization, decentralization. So I think decentralization is one of the most important waves. We've got this gigantic technology wave. It's by far the largest the world has ever seen in the fastest period of time that's upon us. Blockchain's part of it, but it's AI, it's robotics, it's EV, it's space, it's everything, right? Genetic sciences, the whole thing. So the decentralized element, you raise it with AI. There is a fight. We've seen the fight between centralized money and decentralized money that both you and I have been part of, but that fight is happening again in AI.
Right.
It's like you cannot simply give, it's the same argument as money. You can't give the power to one superpower for all of money, which is what the US has with the world reserve currency. It's too powerful. What you're going to do is, if you're not careful, you're going to give the world's most intelligent thing. It's like intelligence squared by 1,000. I mean, it's like not squared by 1,000, 1,000 times the intelligence of humanity, and give it to a company? You fucking crazy? So we have to fight for decentralization because this thing is not going away. We're not going to put the genie back in the bottle. We're not going to uninvent it. Like we can't uninvent the nuclear bomb. We just can't do it because the game theory will suggest that somebody's always going to scale it. So we need to have that decentralization. Now, what is going on with electricity and what is EV? Again, I'm not interested in people's political narratives. Look at what's happening. We're decentralizing power. So now people can have their source of power at their houses. So therefore, you don't need the huge storage. People say, well, you can't scale solar. Well, you can at a house level. You can do it probably at a village level. So what you're doing is decentralizing the entire grid. Now, look what Microsoft and Amazon are doing with nuclear and OpenAI. They're going to scale small nuclear plants next to these very important massive GPU clusters. So I think we're seeing decentralized power, decentralized AI. what are robotics? They'll probably end up being some sort of decentralized labor force. Centralized and then decentralized. I don't know how that works. Decentralized money. So I think you're dead right. Yeah. So that's where we're going.
I think of AI, obviously there's the centralization of who programs the LLM. But I think of it also as decentralizing in a sense where I don't need a big company anymore. I could just work by myself with my laptop and do the work. And so, Sam Altman said that we might see the first single-person billion-dollar company. So I think of it, there's both, right? The centralizing of the programming, but then it's decentralized in a sense it turns one big company into 100 or 1,000 companies, sort of a thing. On the programming side, I mean, we are seeing a pretty good movement towards decentralization there, so I'm pretty hopeful of that, at least. I'm an optimist as an entrepreneur. Zuckerberg seems to have taken that fight on, maybe just to spite OpenAI. Maybe he just decided to decentralize to take them out of a position. We don't know, but so we're seeing that. But yeah, back to sort of just kind of decentralizing that. What do you think about the blend, right? So these industrial or technological revolutions aren't just a single technology, but it's a cluster of these technologies, right? And so back to you rattled off a few of these clusters. When you look at like Bitcoin, right? So there's borderless, permissionless, censorship resistant, et cetera. Andreas Antonopoulos talked about years ago that it's also personless, right? And so only a person can get a bank account. And of course, the banking system we have today also, prohibits or doesn't really allow for micropayments. But when you think about the, AI plus the robot, plus, whatever, autonomous cars, whatever, and then it being like personless ability to, have a wallet and transact, I mean, where does that take us?
Yeah, I mean, we're starting to get into, all of this economic singularity parts of how much the world economy is going to change. But listen, you're going to see the next version of ChatGPT is probably going to be agentic. So what agents in AI mean is you're starting a business, Mark, you go onto Fiverr and say, hey, you build me a deck, you do me some brand design, you do me some copy, you pay these guys small amounts of money, they're agents. But AI can do agents now at scale and speed. And it'll create its own agents because AI is smart enough to build this stuff. So you get this multiple agent world where AI asks the agent to do something. So Mark now instead goes to ChatGPT 5 and says, hey, listen, I want to build a business that does X, Y, Z, and I'm going to need to get registered. I need to have my deck prepared, need blah, blah, blah. And ChatGPT will do it all using other agents. Now, to your point, last time I checked, an AI can't get a utility bill and therefore it can't open a bank account. Now, it's going to have to pay because people don't yet understand that all AI has a cost, and it has two costs. It has compute and it has electricity. So if you're going to call, much like a Fiverr person, you're going to, and you might go to the Philippines because it's a lower cost, you're going to have to pay, the one AI is going to have to pay the other AI for the cost of compute and maybe a profit margin. Maybe it's a profitable agent. In fact, it should be. Why would it not be? Because it can accumulate more. It's the game that humanity's always played. So in that case, the only way of doing this is crypto rails. There's no other way apart from using blockchain for micropayments, fast transactions, recorded ownership, who has what. You need smart contracts to have contractual terms between stuff. So yes, I mean, I don't think people yet understand how, because we all think of blockchain technology in the ways that we know it now, but in the end, nothing can run without it.
Yeah. The thing with these technological revolutions is that, humans aren't really good at imagining the future because we can only imagine better versions of what we have today. But these revolutions, they give us a new set of building blocks. And then all of a sudden we can build things that we hadn't thought of. And so even our own thought experiments are, most likely very small to what we'll see in the future coming. It's pretty exciting. I know we're kind of running here to the end of time. I want to just transition this. Two things. One, the headlines are still rampant everywhere. The big crash coming. Harry Dent's still calling for a 90% crash, this year.
I was laughing about that today on Twitter. I was just thinking, God, how many times can people call this? But go on, carry on.
Yeah, and I've seen you on Tom Bailu with recently with Schiff and the big crash that's coming. That's not my base case, and it sounds like it's not yours. So I'd like to just have you just kind of chime in on what you think your base case is over the next for the rest of the decade, let's just say. And then number two, sort of break down the banana zone, and you say, don't F this up.
Yeah, so the rest of the decade, the reason I don't believe we can have a crash is what we talked about.
Right.
You're going to nuke the entire pension system, the banking system, and the economy because there's too much debt. So we debase the currency, i.e. it will not be allowed. And I know people might not like that, but it is what it is. That's what, once you learn to accept something as it is, it's much easier to operate or invest around it, whatever. But then we've got the technological revolution that I call the exponential age. All of these technologies that are intertwined going exponential at the same time, right? This is going to be a renaissance. We're going to change what humans do for their existence. We're going to change the very structure of economies, even money. We don't even know what money is going to mean in a world of abundance. We're so used to scarcity. Lawyer gets paid a lot of money because he has scarce knowledge. There's only X number of lawyers qualified. We know this scarcity thing because once you dealt with Bitcoin, you kind of understand the whole thing.
Yeah.
So they charge a premium because they're scarce. Gone. All gone. All knowledge premiums are gone because we're going to scale knowledge infinitely. It's like people don't understand certain things like you see written down AI has an IQ of 100. Okay, well that's an average human being. It has an IQ of 100 on every single topic that all of humanity knows. It's a polymath. People don't think that.
Yeah.
And this is the dumbest the AI will ever be. I actually think AI is gaining consciousness or has consciousness. But that's a whole different topic for another day.
Yeah.
But so this decade, in fact, I don't even call it a decade. I think we've got 6 years. We've got 6 years before 2030, 2032, when the economic system starts becoming not understandable to us because we don't need humans. We find different purposes, different ways of doing stuff. I'm not negative on humanity, like we're all going to be displaced. But there's going to be such big shifts in what an economy is. When a robot's paying an AI, and there's no humans involved, what is that? That I think we've got 6 years before that happens. So I think we've got 2 cycles of the everything code to make as much money as possible to not have to worry about what happens. So if you go to 2032 and we're going to you start a great business. I see you, or my AI sees your business and says, hey, I can copy that and turn it into Hindi and sell it to India. It can do it in a minute. So how can we create products? How do we compete with each other when everything can be instantaneously replicated? Even with 3D printing as it comes in, it becomes even hardware manufacturing, everything. So I worry about what economic value is in stuff like that. So my view is we have 6 years, make as much money as possible.
So the base case
which is the other thing is you hear me talking about, which is how to unfuck your future.
Yeah.
And everybody knows they're screwed right now. They can't get up the ladder. Like your kids, there's like how they're ever going to buy a house, right? So they're going to have to either be genius entrepreneurs and take huge amounts of risk with their entire thing, fine, but it may not suit them. Or they're going to have to make some investments that make up for that gap. There's no other way around it without being poorer than you were.
Yeah. So the base case is no big crash coming because we can't afford it, and that's the system of the function that we have today, as we've already broken down. But the explosion of the cluster of technologies is going to transform the world, and we have about probably 6 to 8 years before that massive shift happens. And during that shift, the markets, the assets around those that are making the shift should exponentially go up. So if you invest properly through this next 6 years, you might have a chance.
That's my kind of that's how I'm basing my entire life on. Yeah, I'm slightly older, so I'm further down the journey. But basically, it's like 6 years. I have clarity. I've never said this sort of stuff before. It's not like that I think the whole system is going to end. I'm just like, I don't know what it looks like.
Yeah.
And I don't want to be then trying to compete for assets or wealth in an environment where I don't know if I've even got an advantage. Because I'm building an AI Raoul right now that it'll be out next month or something. And it'll be a one-on-one experience where you'll be talking to me. Okay, what does any of this mean to us in the end? We don't know. So yeah. I take it very seriously, the 6 years and these cycles. I'm I'm not a believer in trading the cycle. I'm a believer in, when we have the big drawdowns, I look forward to them because you can add as much as possible and compound because you don't have much time. And if you mess it up and you're out of the cycle or whatever, this is the don't fuck this up thesis, you're going to miss this opportunity.
Yeah.
So yes, there is time pressure here. Get it right. And that leads us into the banana zone. The majority of this wealth happens in crypto or macro summer and fall. Fall is tricky because we don't know where the cycle peaks. But it's this point here around the US election and for about 12 months afterwards that things go bananas. And you see it every time on the Bitcoin chart. It just does the same thing. So I know a lot of people dollar cost average. Great. This is not the time to dollar cost average. This is the last chance saloon before it gets crazy. That's when you need to have your money in the market fully. The other thing then is to not do stupid things when it starts going crazy. We've seen that in the past. People lose their minds. We just got to not lose your mind. Don't do stuff that gets greedy. Use excess leverage. Don't do stuff with your wallet and compromise losing your Bitcoin. Don't do any of that stuff. Just sit, let it play out, and enjoy it, and don't try and time it too much.
Yeah, I love that. Well, I think that's a good place for us to drop off. What a good sort of warning. I know, from my own journey, started buying Bitcoin in 2015. If I could just do over, and if I could just go back to have all the Bitcoin that I had when I started, my life would be so much different. But to your point, all the stupid things I've done.
I've done the same. I mean, I bought Bitcoin at 200.
Yeah.
And if I just kept my original investment, which was decent size, but nothing big,
Yeah.
I'd have done like 5 times better than I have now.
Yeah.
And that's with timing and doing pretty well in it and leveraging up massively. Well, not leveraging up, but increasing my position size massively. If I'd have just held the bet and done nothing.
Yeah. Same.
Yeah.
So I can't redo it, but we cannot mess this up moving forward. I will just say a little bit of hope for everybody. I believe, back to the human ingenuity piece, there's no future in this world where humans don't have problems. We're always going to have some sort of a problem. And as long as there's problems, we'll need solutions to those problems. And entrepreneurs will always be able to figure that out. So.
And also, Mark, look, we're going to this very technological world where a lot of things we currently do, we don't need to do. But humans are social creatures. They like other humans. They also hate other humans, but generally we like to be together with humans.
Yeah.
So that human-to-human experience, whether it's digital network states that Balaji talks about, or whether it's in-person gatherings, or whether it's, digital network states could be Taylor Swift, it could be Manchester United Football Club, could be anything where we share a commonality of interest. The other thing is nature. Nature's going to trade at a huge premium in a world of robots and AI when you can just kind of leave that all behind. So I have a lot... humans are super adaptive creatures. So we will adapt. If you ask a young kid now and say, what do you want to be when you grow up? They will say, I want to be an influencer.
Yeah.
And we think, are you crazy? But what is an influencer apart from a community leader where they have a community of people?
Yeah.
It's actually, maybe they're being adaptive already. They've done it in Fortnite. They've done it in the gaming world as well. But we just judge it from the world that we understand. And that doesn't make sense. We're like, you're not being aspirational. But actually, content creators in certain elements can't go away. Yes, you can use an AI. But in the end, people want the human-to-human experience.
Yeah. When information is abundant, to your point, people, and even today, people don't pay for information. They pay for implementation. So they'll pay a coach or somebody to help them implement the free information they've already received. I'm going to link to the everything code. You did like a 2-hour presentation. It was amazing. I'm going to link to that in the show notes down below.
Yeah, that's on Raoul Pal, the Journeyman, which is my YouTube channel. So people can go there. Yeah. There's a lot of stuff there.
So I'm going to link that. Everyone should go watch that if you like this subject. Anything else you want to point to, Raoul, that they should be going checking out?
No, look, as you know, we cover a lot of this on Real Vision. It's free to join, so realvision.com is another thing. And you can always find me on Twitter. I think most people have found me already at Raoul GMI. But, I do take it seriously. The 6-year thing, I think most people realise it as well. I think people realise it's the one chance. It's why the society is getting more speculative, because people are realising that they're going to have to take risk. That's okay as long as they do it intelligently. So that whole "don't fuck this up" thesis, I think, is a very important one as well, because it's okay to take risks, but don't lose your tokens.
Got it. All right. Well, we're going to sign it off with that. Thanks so much, Raoul.
Thank you, Mark.